Hey, what's up guys? So if you clicked on this video, you probably have been hearing a lot of talk about stocks, investing, and how everyday people are making their money work for them, turning $100 into $200 with little to no effort. Now, while you might have a few $1,000s saved up in a bank account and really want to start putting it to work, investing can seem very shady, risky, and hard to do. However, it doesn't have to be this way. My name's Krishna, and today I'm going to give you guys an explanation as to what investing is, how to do it safely, and then how you can get started today. Alright, so first of all, let's talk about what some of the goals of investing might be. Now, if you ask a group of people, some of them might say that they want to retire comfortably with a decent amount of money in their bank account that they can survive off of. Other people might say that they want to eventually afford a Lamborghini and their goal of investing is to buy that Lamborghini. However, for me, I think that the basic goal of investing is simply just to beat inflation and preserve your money. Now, if you have grandparents and have ever went to a supermarket with them, they might have looked at the milk and said, wow, that's expensive. Back in my day, milk was only 20 cents a gallon, and in the 1950s and 1940s, it probably was 20 cents a gallon. However, right now, milk is priced in at about $3.60 a gallon, and that's simply because of inflation, which devalues your money every year by about 2%. And there are a bunch of reasons as to why our money loses 2% of its value every single year, but the most common reason is simply just because the government actually prints more money every year. This means that the total amount of money goes up and each individual dollar is just going to be worth less. That means that if you took $10,000, stuffed it in a mattress, and then waited 20 years, whenever you came back and actually tried to use that $10,000 after the 20 years, that money would be worth significantly less and would buy you a ton less stuff than you could have just bought today. So how can we go about fighting this inevitable inflation that seems to always be looming above us, taking away the buying power of our money? And to put it simply, the answer is just investing. Now, when you go ahead and invest, you're basically taking your money and then putting it into something else, and then hoping that something else pays you more money than you put in. Not only will investing help you offshoot the impacts of inflation, but in most cases, it will actually help you build your wealth long into the future. For example, if you go ahead and open a savings account at your local bank, they might give you a solid interest rate of 0.2%. This means that for every $1,000 that you put into the bank account, they'll go ahead and give you $2. Now, this doesn't really sound that good, and that's because it isn't. Inflation rate right now is 2%, and if they're giving you 0.2%, that means that you're not beating inflation, so you should definitely look for something else to put your money into. So there are really two time and tested ways that we can go ahead and get a better return on our money than a simple savings account. The first way is through real estate, where you go ahead and buy a property, which can be quite expensive. Then you either fix the property and rent it, or just fix the property, or just rent the property, and then eventually, as time goes by, your property simply just becomes worth more because that's what property does, and then eventually you sell the property for more money than you actually bought it, and then boom, you have more money. The second way of receiving that higher return is through the stock market, which is what we're going to be covering in this video. Think of a stock as a tiny piece of ownership of a company. For example, if you have an iPhone, an iPad, or an iMac, and you just really like the products, you might want to go ahead and buy some shares or stock in the company that makes them, called Apple. So hypothetically, now you go and buy one share of Apple for $200. Now, for the next 5 years, Apple continues to innovate, they continue to make really nice products, they continue to make a lot more money, and the company just doubles in size. And since the company is worth double, each share that you had before is now worth double, meaning that your one share that you had from 5 years ago is now worth double, aka $200 to $400. Now, if you want to go ahead and sell that one share, you just sold it for $400, meaning that you now have the $200 that you initially put in, and now an extra $200 that you got simply because the share appreciated in value. And since that, 100% gain over 5 years is a lot more than the inflation, you basically beat inflation and have a lot of money to spare. Also, if Apple has a really good year and makes a ton of money, they actually might give something called a dividend, which is they take some of the profits that they've made and they distribute it across to all of their shareholders, meaning just for holding the Apple stock, you might actually get some of Apple's profits deposited straight into your account. Alright, so now that you hopefully understand what a share is, let's talk about how you can go ahead and actually buy one. So in the United States, there are a bunch of different account types and free brokerages that you can choose from, so let's go ahead and discuss them real quick. For most people, an individual brokerage account will work the best, but if you want to try and get into some retirement accounts, I'd consider looking into an IRA or a Roth IRA. These are benefit accounts that can save you a lot of money from taxes whenever you go and retire, but they actually have a lot of rules and regulations as to how much money you can deposit and when you can withdraw. For example, a Roth IRA limits your deposits to your account to just $6,000 a year, and if you try and withdraw your money before you're the age of 59 and a half, you actually lose 10% of your gains, which is definitely not something that you want to have happen to you. Now, looking into brokerages, most of them have thousands of different stocks that you can choose from and have relatively simple UIs that really anyone can use. I've went ahead and linked Robinhood and Webull down below in the description, so go ahead and check those out, and if you want to use my link to sign up, you'll get, I think, 2 free stocks worth up to $1,850 from Webull, and then you'll just get a regular free stock from Robinhood whenever you sign up. So once you're on these sites, the setup is fairly simple. As you can see from this form, they'll want some pretty basic information about you, like your name, social security number, and address. I know a lot of people might be skeptical, but don't be scared of giving this information to these companies. They're heavily regulated by the SEC, and these are literally multi-billion-dollar companies. So after you went ahead and verified your account and they basically know that you are who you say you are, you can just go and add funds to the account via a debit card or through an ACH bank transfer. And then once that money's in, it's really as simple as just going into the search area, typing whatever stock you want, and then pressing buy. Now, if you're under the age of 18, don't be discouraged because you can still go ahead and invest with literally like no problems. All you need to do is just kind of go up to your parents and then ask them to open something called a custodial or a parental brokerage account for you. Now, the process is that your parents will own the account for you, and then whenever you actually turn 18, that account becomes yours, all the money in it becomes yours, and then you can basically trade with a head start that everyone else probably didn't have. Alright, so you went ahead and made an account, but now you don't exactly know what to buy. And generally, I believe that for most people, it's actually a lot safer to just not buy individual stocks. While we think that a company right now is great, we don't really know what's going on in management's head behind the scenes. We don't know that in the future, these companies will continue to do well as they're doing right now. And it's a lot of this risk that makes me not really want to recommend individual stocks to newer investors. For example, while Apple is just an amazingly made company, we don't really know what's happening behind the scenes, and then we don't even know if it's going to be around within the next 10 to 20 years. For example, something might come out and then just completely push Apple out of business. Now, this isn't really probable, but it actually has happened quite frequently in our recent history. Take a look at Kodak, which was one of the most valuable companies in the world at one point, which is now really just trading at almost nothing. The same thing also happened with IBM, which was considered to be the most revolutionary computer company in the entire world, and compared to where it was trading at, a couple decades ago, it's not just worth as much anymore. So rather than individually picking stocks and hoping that the company doesn't go out of business in the next 20 to 30 years, we can invest in something called an index fund. Now, to put it simply, an index fund is a company that buys a ton of stock in a ton of different companies. If you go ahead and invest in that index fund, you basically own a tiny little bit of all of the companies that index fund holds. Now, let's say that there's an index fund that follows the S&P 500, the leading benchmark for the last 100 years to basically compare every single investment to. This company owns stock in 500 of the greatest American companies. Now, let's just say that out of the 500 companies that this fund owns, let's say 5 of them go down and lose a lot of their value. Now, this doesn't really matter because for every 5 that go down, there's probably 5 that go up, and in fact, historically, for every 5 that go down, there's actually probably 10 that go up in the same amount. And you don't have to rely on one company doing well, you just kind of have to rely on the whole market doing well, which is pretty much guaranteed long term. Now, annually, an index following the S&P 500 is expected to grow about 10% a year, which is basically what it's been doing for the last 100% years. Now, we both know that inflation takes about 2% of your money, meaning that we have about an 8% gain, meaning that, even though we did lose 2% of our money to inflation, that 8% gain is free money for us. As that extra 8% keeps compounding, we can literally look at a chart that shows the power of compound interest, which is literally just taking the money that that you're making, putting it back into what you invested in and just watching it grow. So if you guys are looking for any of these basic index funds to buy that are pretty broad and have a lot of potential upside long in the future, there are dozens of really great ETFs and index funds, but the ones I will personally recommend are VWO, QQQ, and SPY. VWO will track all of the stocks in the stock market. QQQ will basically track a lot of the massive tech stocks that we know and love, and then SPY will track all the stocks in the S&P 500. In the last 10 years, SPY has risen from $100 all the way up to $400. Now, this is a 300% gain, and you guys already know from this inflation 2% gain thing, I mean, this is just blowing it out of the water. Now, while looking at the chart, we can see that there were some times where the value of the stock actually fell in the short term. In the long term, it literally just looks like a staircase upwards. Since in the short term, index funds can fall for reasons that we honestly might have no control over, it's definitely important to have at least 3 to 6 months worth of rent, food, and supplies ready to go just in case. In reality, the worst thing that you could possibly do is take all your money and just throw it all at an investment, because like I said, if it falls in the short term and suddenly an emergency pops up, then you don't really have any money and you're actually forced to sell your stock. Now, if that stock is currently down from when you originally bought it, not only did you have to sell your stock at a loss, but whenever that goes back up, you're actually still going to be red. So I guess on top of making sure that you have a safety net of 3 to 6 months worth of just kind of supplies ready to go, I also think that you should definitely start looking at dollar cost averaging, which is a strategy that a lot of investors use to basically safeguard themselves from market crashes and kind of just build their fortune over time. And the way dollar cost averaging works is fairly simple. It's literally just taking a certain amount of money and at a certain time period just putting that money into the market. For example, for me, I like to buy some SPY and QQQ every 2 weeks, so I might take $1,000 every 2 weeks and then just simply buy that. This means that if QQQ is up, I'll just buy it when it's up, and let's say the market corrects and it goes down, well, I just bought some at a lower price, which is pretty nice. However, overall, as I keep buying, I'll just continue getting a better average on my price, and then eventually I'll just keep building my wealth slowly but steadily. Now, for those of you that are young, you have some extra money that you don't really need right now, and you're honestly willing to gamble on some individual stocks, I'm right there with you. While putting money in index funds consistently over time and dollar cost averaging is a consistently proven way to make money and build long-term wealth, you can honestly make a lot of money simply picking great stocks that you think can do well in the future. However, I definitely recommend that you guys always do your research. You can use tools like Yahoo Finance and Finviz, which I'll go ahead and link down below to do your research and make sure that the companies are what they say they are and that they actually have pretty good financials. I haven't actually made a video on Yahoo Finance and Finviz, so if you want me to do that and kind of give you guys a tutorial as to how these work and how you can use them to find some really good stock, let me know and we can get to it in a later video. So all in all, I really hope that you guys are able to get some pretty good information out of this. I tried to explain a little bit at a surface level as to what really a stock is, how to kind of do this whole thing safely, and some of the ways that you can actually physically go and do this after watching this video. So if you guys did enjoy it, make sure to go ahead and drop a like down below. There's a lot of different topics that I want to explore, like kind of how to analyze financial statements, 10Ks, 10Qs, some of the financial calculators, and stuff like that. So if you're interested, make sure to drop a like, tell me in the comment section below, and make sure you subscribe to the channel. So anyways, I'll see you guys in the next one. Peace out.